Hey, good morning. Hi, everyone. Welcome to the third session of the Infrastructure and Nature webinar series. Through 6 sessions, we're working our way through the infrastructure life cycle. We've covered policy and planning and the enabling environment, and today we're going to focus on finance, or how to deal with biodiversity-related financial risk in infrastructure investments. My name is Kate Newman, Vice President for Sustainable Infrastructure at World Wildlife Fund in the United States. Last year, a group of individuals of around 20 organizations, ranging from NGOs to companies to multilateral development banks and research institutions, came together to co-host a week-long pavilion at the IUCN World Conservation Congress on the fascinating topic of how the infrastructure of our future can be developed in harmony with nature for the good of our planet and society's well-being. One of the central themes of the Congress is economic and financial systems. How can we support nature for the good of our planet and the good of humans, while sustaining nature and addressing the impacts of climate change? Infrastructure is at the foundation of economic development, and the private sector has a central role in generating the infrastructure we need. So the pavilion was designed to explore how the private sector, civil society, and government can work together to reimagine 2 things. How can we both protect and support nature's engineering that continues to provide essential infrastructure services or nature-based solutions? And how can we develop the built infrastructure of our future to ensure a healthy planet, thriving communities tomorrow, and for generations to come? In spite of the delays brought about by the pandemic this year, critical decisions are still being made and deliberations continue on global agreements like the Convention on Biological Diversity and the one on climate change. But along with the World Conservation Congress, all of these are now taking place in 2021. So our group decided to go ahead and start the discussions we anticipate for the Congress and hold this virtual pavilion over these 2 months. We're now halfway through our series. So let's get started. Please let me introduce Kristina Pelikanova, one of the organizers of this session, to get the ball rolling. Kristina is a civil society officer at the European Investment Bank, covering stakeholder engagement, transparency-related issues in the area of climate and environment. Take it away, Kristina.
Thank you very much, Kate, for this introduction. Good morning, good afternoon, evening, everyone. It's really great to see so many of you joining us from across the globe for this event. So my name is Kristina, and I'm here to introduce the flow of the session and also share some housekeeping rules with you. So as many of you agree, biodiversity loss exposes financial institutions to material risk, and this is particularly true for infrastructure investments. In this session, we will discuss how to investment decisions. We have with us a very experienced panel, combining perspectives from institutional investors, banking and insurance sector, as well as civil society, public, private entities. And we will have a discussion with the panelists for about 50 minutes, followed by a Q&A with the audience. Your microphones are muted by default, we encourage you to post your questions in the little Q&A function at the bottom of your screen. We will address the questions at the end of the presentation. So now it is my pleasure to introduce Eric Asche, who is the head of UN Environment Programme Finance Initiative, UNEP-FI, who will be the moderator of our session. As many of you know, UNEP-FI is a global partnership that brings together the UN with a group of banks, insurers, managers all over the world to develop sustainable finance and responsible investment agendas. And over the years, UNEP-FI established some of the most important sustainability-oriented frameworks within the finance industry, including the principles for responsible investment, the principles for sustainable insurance, and most recently also the principles for responsible banking. Eric, in his role, oversees governance, strategy, and day-to-day management of UNEP-FI. And as such, Eric has really hands-on experience with accelerating integration of sustainability risks into financial practice, including biodiversity and natural capital loss, which is of particular relevance for today's session. So without further ado, let me now pass the word to Eric. Thank you.
Thank you very much, Kristina and Kate and all colleagues, and we appreciate the invitation. And this is definitely a critically important discussion We have an expert panel, which really gives a great cross-section of the actors who need to be involved in infrastructure development and considering the notion of biodiversity loss, which we within the UN certainly believe this is one of the most decisive issues that all investors and all stakeholders need to be considering. Ecosystems such as forests, soil, land, and the ocean are rich in biodiversity. And this variation in plant species and genetic material is essentially the living fabric of our planet. Globally, biodiversity is declining at an unprecedented rate, with up to 1 million species threatened with extinction. A recent report from Swiss Re, and I'm very happy to have a Swiss Re representative today on the panel, report found that over 1/5 of countries worldwide are at risk of ecosystem collapse. So as businesses depend on and impact nature through the activities and supply chains, this is an issue that should be central to their thinking. According to the World Economic Forum, the WEF, more than half the world's GDP, so about $44 trillion of economic value, is moderately or highly dependent on nature. This is significant, and I think we all know today this is a consideration that maybe we see in our Facebook threads or feeds, but how exactly you integrate that into infrastructure development and financing decisions. We're talking about the financial sector perspective. I think it's still rather early days and we need to make serious progress. The race to halt and reverse biodiversity loss has begun. And we've already heard some reference to that from Kate. Next year, countries are expected to adopt an ambitious and transformative post-2020 global biodiversity framework at the UN Biodiversity Conference, the CBD COP15, which will be held in China. 2021 will also start the UN Decade of Ecosystems Restoration. However, as has already been mentioned, governments and policymakers can definitely not tackle this issue on their own. Rebuilding and replenishing our natural capital will take efforts from all parts of society, including from infrastructure developers, investors, lenders, insurers, etc. I don't think I need to remind you that infrastructure projects have a very significant and large-scale impact on biodiversity and really depend on natural capital for much of their raw material. This large-scale impact is increasing as emerging economies develop and urbanize. Global infrastructure investment has grown at an average annualized rate of about 10% for the last 2 decades. Significant means a significant opportunity, but significant risks. The bulk of future infrastructure spending is going to occur in emerging economies, as we all know, which presents an enormous challenge to keep nature intact and ensure no damaging knock-on effects to communities. So I think that the key question we're going to consider today is how can financial institutions around the world accelerate the response on biodiversity, even in those regions which maybe sometimes don't have all the policy frameworks and civil society capacity or focus in place. So my own organization, UNEP Finance Initiative, which Christina has already mentioned, we work with a group of 350 of the mostly larger banks, insurers, and a subset of asset managers globally, essentially looking at how do we integrate sustainability considerations into financial practice, and largely through the establishment of normative frameworks. The Principles of Responsible Investment is the largest of those. Today, 80% of institutional investors are signatories and have various implementation requirements. The most recent framework was the Principles of Responsible Banking, launched just last year in New York with Secretary General Antonio Guterres and 130 banks. Today, it's nearly 200 banks representing about 40% of global banking assets. This banking framework is a target setting framework, which is the first major financial sector framework to be so. So it's not so much only about risks today, ESG risks, it's also about aligning with society's needs as defined by the SDGs, the Paris Agreement, and other relevant frameworks. This is relevant, I think, also for the discussions today, because there is the two-side aspect of looking at these issues. On the risk side, one of the areas the signatories to the PRB, the Protocol Banking, have been working on is the notion of biodiversity-related issues, risks, and targets. We are involved also with WWF and others in the establishment of a task force for nature-related financial disclosures, what essentially we believe will be called the TNFD, which is similar to what has been done for climate, although at a very early stage of development, but we believe very important. This type of framework would require corporates, including certainly those related to infrastructure, to start providing nature-related disclosures, providing decision-useful information that then will be factoring into investment decisions in the corporates and within the financial sector and capital markets. There are also some well-known standards in the market already, including the IFC Performance Standard 6 and the Equator Principles, which last year were updated to version 4, which included enhanced efforts around biodiversity and ecosystems management. I think as well as being a core driver of biodiversity loss, the building and operating of infrastructure is responsible for more than 60% of global greenhouse gas emissions. Therefore, infrastructure investment, has a dual responsibility, both in terms of addressing the climate and nature. And we believe these are goals that are intertwined and need to be examined together. So these twin crises cannot be treated in isolation. As we all know, I think climate, for many reasons, has getting a lot of positive momentum these days. And I call out the governments of Korea, of Japan, of China, Philippines, all of who made very important recent announcements in terms of getting to net zero, in terms of CO2 emissions by 2050 or there around. This is incredibly important. And I think what we're going to talk about today is that the infrastructure that's going to be developed increasingly is going to be low carbon, but we have to certainly make sure that it's based on economic assessments that also don't fail on the side of nature. So it raises the question of, what is net zero biodiversity impact, or even net positive impact? What does this look like within an infrastructure portfolio? How can infrastructure investors and developers embed biodiversity into their decision-making? What sort of tools do they need to help to identify, measure, and manage these biodiversity-related financial risks? And what are the opportunities to ensure sound financial return and risk management by accounting for biodiversity factors in infrastructure development and operation? So with us today to discuss these important topics is a fantastic expert panel. I'm just going to name them here, and then I'm going to ask them to give a quick introduction. So we have Nigel Beck, who's the executive and head for sustainable finance at Standard Bank Group, one of the largest commercial banks operating on the African subcontinent. We have Nick Butcher, Vice Chairman for Infrastructure and Energy Group from Macquarie Capital, one of the largest infrastructure investments in the world. We have Eva Meyerhofer, Lead Biodiversity and Environmental Specialist at EIB, one of the largest development banks in the world. And Christian Wertley, Head of Infrastructure for Public Sector Solutions at Swiss Re, the larger provider of reinsurance in the world. So we have the big players in the discussion today. We also have one of the most important members of civil society, Helena Wright, who's Vice President for Sustainable Infrastructure and Energy Finance at WWF in Singapore. So it's a great group. It's a knotty issue that has to be broken apart, broken down to understand what are the issues. We all understand at a very wide level the importance of the issues at stake, but breaking it down into decision-useful information is, I think, the challenge that we all need to grasp and deal with. So with that, if I could hand it over to the individual speakers to give just a 1-minute introduction, who they are, who their organizations are, and what they see as the importance related to this topic. Then later, we're going to get into much more detailed discussion. So could I first ask Nigel from Standard Bank?
Sure, no problem. I assume everybody can hear me, and thanks Eric for the introduction. So I'm Nigel Beck. I head sustainable finance for Standard Bank Group. Essentially, my team's responsible for coming up with innovation around green, social, climate, biodiversity related products. We innovate essentially with the various business units and with our clients. So it's a fairly new business unit. We've been around for about 2 years, growing exponentially within the bank, showing you the importance of, I guess, sustainable finance. Prior to this, I used to be the head of ESG risk within the bank. I've also been the longest standing chair of the Equator Principles. And I guess in a previous life, I was actually an ecologist.
Wonderful. Thank you very much, Nigel. I think being able to bring in different areas of expertise really is very, very valuable for understanding the types of issues we're going to talk about today. Okay, could we go to Nick from Macquarie?
Hi everyone, and thank you for the introduction. And it's a pleasure to be invited onto this panel. So I'm a vice chairman at Macquarie Capital in our infrastructure and energy group. Macquarie Group is a global financial institution. And we're one of the largest infrastructure investors and developers globally. We manage about 130 billion of equity invested in infrastructure projects around the world. And through our green investment group, we're one of the largest renewable energy developers. We have a team of about 450 around the world in 25 markets. We're developing over 250 renewable energy projects. So we've achieved some quite reasonable scale in that area. I'm personally passionate about the environment and biodiversity, and I'm particularly interested in the intersection between business and the environment, and seeing how private markets and private capital, which are powerful when they're harnessed in the right way, how they can be directed towards conservation and in particular towards biodiversity, which I think is really a fundamental issue for the world and civil society to tackle. So looking forward to the discussion.
Wonderful. Thanks very much, Nick. How can we harness the markets to deliver returns to shareholders, but do so in a way that also delivers on society's needs? Super. Ava from EIB.
Yes, good afternoon. And very difficult to follow your introduction, Eric. It was very comprehensive. For us, I'm the lead biodiversity and environment specialist at the bank, and I lead the biodiversity agenda. It's always been a Cinderella subject in a way to the climate debate. But you may know that the EIB has new commitments. One is an increase by 50%, and this is for the whole EIB group, to finance climate action and environmental sustainability, and also a commitment, and this is the EIB only, to $1 trillion in climate and environmental sustainability finance. So these are very high targets that we will have to achieve. And one way of doing this is certainly through our infrastructure portfolio. So aligning infrastructure business with the commitments is the only way to advance these objectives. And infrastructure and environmental sustainability and human well-being go hand in hand. The other thing why we are interested in the subject is that we are a large issuer of green bonds, and therefore all these infrastructure projects have to meet certain sustainability requirements, including biodiversity considerations. And I think what has been the driving force now of reframing a bit the debate in biodiversity is the fact that there's been an acknowledgement and an awareness that biodiversity risk is a financial risk. And I think that will push the agenda, and that we will be seeing a much better mainstreaming and integration of biodiversity risk as the climate risk and biodiversity risk are two sides of the same coin. So I think this is an important step forward.
Great. Okay. Thank you very much, Eva. Biodiversity risk is a financial risk. And I think part of the discussions are, what does that mean for the financial sector? How does that get interpreted? Christian, you know something about risk. Swiss Re.
Hi, Eric. Yeah, thanks for having me at the panel. For those who don't know, Swiss Re is actually one of the largest insurance or reinsurance companies in the world. We're working together with insurance companies, but also both corporate and private sector clients. Swiss Re's declared mission is to make the world more resilient. For example, 25 years ago, we were one of the first insurance companies who joined the fight against climate change. But we don't just talk the talk, we also walk the walk. For example, we are a founding partner of the UN-convened Net Zero Asset Owner Alliance. But we are not just a risk taker and a reinsurer, we're also an investor. Collectively, you might know that the insurance industry has roughly $30 trillion under asset management. This money can be invested in infrastructure projects that can make a difference. The insurance and banking industry, together with the public sector, have a social responsibility to insure and invest in infrastructure projects that are sustainable. We also see in recent awareness of the loss of biodiversity and the subsequent collapse of entire ecosystem. And Eric, you actually quoted a Swiss Re study that actually shows that a fifth of the world's ecosystems, or actually a fifth of the countries in this world, have fragile ecosystems. As an industry, we definitely can do better and support therefore projects that are sustainable and take biodiversity issues into account. So in this respect, I actually like to ask a provocative question to the panel. Firstly, how can we actually speed up infrastructure investment in investments or infrastructure investments that have a positive impact on biodiversity? Because frankly speaking, as an insurer, we don't see a lot of those projects coming to the market.
Great. Well, thank you very much, Christian. And I think what we've heard, there are various issues here. EIB wants to, place $1 trillion into climate and I think nature positive investments. We know the capital markets increasingly are putting more emphasis here. We know that particularly in emerging markets, the need to develop infrastructure is growing. And I think one of the key questions is, how do we make sure we do it responsibly? And so if we can start to dig into that, these issues, what we're going to do is we're going to start, and I would like to have Helena from WWF introduce herself, and then she's going to give us a short presentation on a report that WWF and Oliver Weinman has just put out on this issue. And then we will go into the discussion. I should remind participants that we do have a Q&A box. And so if anyone has questions, please feel free to type them in there, and then we will try to get to them through the conversation. Helena, can I hand over to you?
Thanks, Eric. Good to be here today. My name is Helena Wright, and I'm a Vice President at WWF based in Singapore. And we've just brought out a report with Oliver Weinman on the topic of integrating sustainability in infrastructure. So I'm just going to share the key highlights of that report, which was actually just released earlier this month, which should be really relevant to this discussion. I'm just going to share my screen a moment. So yeah, we just brought out this report actually with Oliver Weinman the other week, and I believe some of the other Oliver Weinman colleagues are actually here on the call today as well. And we basically looked at the climate and nature related factors that investors were looking at the moment and how they're being integrated into infrastructure investments. So the report covers the ESG trends, particularly with a focus on climate and nature related considerations. And as you know, and has already been mentioned, infrastructure is responsible for more than 60% of global emissions, as well as being a core driver of biodiversity loss. And we actually did a survey of more than 30 of the largest infrastructure investors. Just over half of them had more than 10 billion in assets under management. We focused on various factors, as you can see here on this slide, including in particular biodiversity, as well as a number of other factors, including physical climate risk. And as you can see from this chart here, and it's already been mentioned by Eric, the PRI is one of the most widely adopted ESG integration frameworks, and the number of signatories of the PRI has been rising over time, as you can see here. And we actually surveyed the investors about the different types of factors that they were integrating into their investments. And what we found, as you can see here in this slide, is that biodiversity has been much less integrated, according to the investors we spoke to, than various other factors and than greenhouse gas emissions. And basically the disclosure and the integration of biodiversity is a lot less prevalent at the moment than it is on the climate side. When we asked the investors actually about their top 3 motivations for integrating ESG, the factors that they told us were driving their ESG integration were actually financial returns, risk management, and also brand reputation. And these factors could be very relevant also when it comes to biodiversity risk as well as for climate risk. And as you can see here from this chart, we looked across the different stages of infrastructure investment decision making. So starting with filtering and screening, then qualitative valuation, modelling and monitoring. And we looked at whether these factors were being integrated. And as you can see there at the bottom for biodiversity, there was a lot less integration, which the investors were actually integrating across the cycle of their investment. They were most likely to be integrating biodiversity in a qualitative way, so much less likely to be using that in valuation modelling. And they're also rarely using biodiversity as a kind of filter or as a screen for their investments. We also looked across the sectors, as you can see in this table. And one particular thing to highlight here was that for renewable energy generation, it seemed that biodiversity was being integrated a lot more. We weren't sure whether that was because those investors were already integrating ESG quite well, and that might be why they were actually investing in renewable energy. But they did actually flag up a number of points concerning renewable energy generation related to biodiversity, such as issues around sort of wind turbine siting and so forth, which can be tackled in various ways, and which would probably be very important to consider as we shift towards net zero as well. And as you can see here from this chart, we asked the investors also about their screening process, and around half of them were actually screening out different types of infrastructure exposures. Most of that was related to climate, so with coal and then followed by oil and gas. Biodiversity was much less likely to be used as a kind of screening or filtering of assets. And also, as you can see here, biodiversity was much less likely to be taken into account in terms of the quantitative metrics, even though biodiversity loss could be actually material and a material financial risk for various investors. Perhaps that's not fully being quantified or taken into account at this stage. Just a couple of case studies here before I turn over to the panel. So firstly, we did a case study of Alliance Global Investors, and they described some of the ways in which they were integrating these factors into their investments. As you can see from this case study here, which is taken from the Thames Tideway project, they did an evaluation of preserving and enhancing biodiversity and ensured there's no net loss of wildlife as well, taking into account biodiversity strategies and actions. Finally, also we interviewed European Investment Bank about their approach, mainly related to air pollution and also carbon pricing. But biodiversity is obviously more difficult to quantify, and the financial institutions are really at an early stage of actually integrating natural capital risk management. So finally, the key takeaways from our report were actually that all of the respondents we talked to and all of the investors that we actually surveyed were planning to increase their ESG integration in future. And most of them mentioned things such as acquiring better data and also enhancing the number of ESG practices. And this shows really that, you know, initiatives such as the Task Force for Nature-related Financial Disclosures will be probably quite important in coming years in sort of enabling investors to acquire better data on this topic. Thanks a lot. And I'll just turn over to the panel for any questions.
Thank you very much, Helena. So I think you've mentioned a number of the issues that we need to dig into a little bit. And I think obviously one of the challenges we have here as compared to climate, we say it's dual challenges, both are very important. It's easier to boil climate down to a price on carbon or a cost related in that way. People understand it more quickly. Biodiversity and nature related risks, exposures, alignment, etc. in many ways can be quite a bit more complicated. And as we know, financiers are fairly simple people. They like to see things black and white, that they can basically, is this relevant? Is this financially material? Does this impact my decision? Or no, it's not, so I shouldn't be focusing on it. I think what I would like to do now is go to the panel, and we have, as I mentioned earlier, we have the banker, the investor, the insurer on the panel, the reinsurer, and then the development bank. And what I'd like to start with is the general question. We're hearing that investors are still at a fairly early stages in integrating nature-related considerations and biodiversity into their investments or financing decisions. So can I go to the panel to give your short reflections on what do you think the one or two the key barriers are that are preventing you from making these decisions? You understand it's an issue, but going from understanding to actually being able to impact and influence your decisions, what are the barriers involved? Could we start with Nigel from the banking perspective?
Sure, no problem. So I think, you're 100% right. If I look at the data that's come out around investors and how they view biodiversity, it's definitely coming out kind of the bottom drawer when you look at the various different aspects. So if you look at a study also by institutional investors fairly broadly, they're seeing, water management, air emissions, environmental management at the top, even decommissioning, rehabilitation above, and then biodiversity and ecosystems literally at the bottom, just above other. And, only 38%, see that as particularly important. So I think, I think we're all in agreement around that. In my mind, there's a few reasons for that. First of all, the ability to capture data accurately and comparably. So, and I think this goes to what you said earlier around the TCFD. So, that's a very similar process where they're trying to take climate change information, you're trying to disclose information and be able to compare apples with apples. I think, from a biodiversity perspective, if you could get to a position where you could capture information and compare it on a like-for-like basis, it makes it a lot easier to integrate products. And I think we're going to touch on some of that a little bit later, but it makes it a lot easier. So it's very much around those that I see as kind of the impediments. And then also, from an investor side, trying to convince investors that biodiversity is not just something that's philanthropy. It's something that actually makes commercial sense. So if you put together, for example, a biodiversity product, so if I was to put together some type of biodiversity impact bond, they would be cautious around it because there might be an impact on the coupon. So, for example, they're going to have to weigh up, they'd all love to do it, but there might be risk around the coupon that they wouldn't be willing to take. So they have to change the way, bankers have to change the way they think and how they model for these type of instruments. But we can touch on that later.
Great. Thanks very much, Nigel. Nick, from the Macquarie Infrastructure Development investor perspective.
So, yes, I see some similar barriers or impediments. I'd certainly agree measurement. There's a real need for a consistent and broadly applied standard for measuring biodiversity risks. If you can't measure something, you can't improve it. And so from an investor's perspective, what is the right way to measure our biodiversity impact? What is the biodiversity footprint of my particular project? But not something that we can clearly necessarily answer. We can measure our carbon footprint, and a carbon footprint in one part of the world is going to be understandable in another part of the world. But biodiversity, as you said, is more complex. So how do we actually how can we measure the impact in a consistent manner? And I think the other is reporting. That, to me, disclosure is really essential here to drive change. And I think policymakers and business and the finance industry, we need to be working to really develop a standardized reporting basis for biodiversity, and then really work to ensure that companies are acting in accordance with that standard. I think there's certainly a role for financial regulators and central banks to require reporting of the biodiversity risk and impact. And so I think with measurement and reporting, that will really elevate this risk to levels beyond where it really is at today.
Great. Okay. Well, thanks very much, Nick. Now I'm going to come to Christian to bring in the insurance risk management perspective, and then I'm going to go to Ava. And Ava, my question around EIB will be, what are you doing? Also, what does a development bank do to respond to these challenges that the banks, insurers, and investors are pointing out? What are the public-private ways of how we can help manage these risks together in terms of trying to address some of these issues? But Christian, from the Swiss Re perspective, what do you see as the biggest barriers?
I think I agree with Helen, Nick, that biodiversity is really hard to quantify and hard to measure. I think that's one of the main issues we see. I guess if you look at the last 10 years, good progress has been made in anything that is around green energy. For instance, the world made good progress in basically replacing polluted energy with green energy projects such as wind and solar. However, we see less projects coming to the market for example, that capture nature-based solutions. And I think one of the problems is that externalities are often not priced. I mean, the pollution very often doesn't have a price, and therefore I think we actually underestimate the cost of those projects. So if a bad project actually gets on the market at the IRR that looks very attractive without having this cost or these externalities that actually cause long-term damage, then I think per definition we don't have a fair market price, and somehow we have to measure the two. I think bottom line, I think we have to come up with standards to define what biodiversity is and how we can get it measured. But on the other hand, we also have to level the playing field between the different solutions.
Thank you very much, Christian. I think you hit one of the challenges definitely there, and sometimes from the investor and universe of the financiers is basically to say, why is it my responsibility to address a societal objective? My mandate is to address financial objectives. And therefore we need to price in the pollution if you want it really to be addressed. And I think that definitely is a challenge to regulators. Although, as I think we've seen on the climate side, that's not really an excuse to sit back, because climate risks, particularly in terms of physical risks, it's already happening. And I think the same can be applied to natural nature, biodiversity type risks. And therefore it's not, you can't say, well, let's wait for the regulator as our portfolios basically fall apart. There is motivation, I think, on one side to immediately start to act, to integrate these issues, understand what the impacts are on the portfolio. And then also there's a very important signaling effect, I think, for investors and other financial actors to step up, showing that they take these issues seriously. That gives signals to the corporates, the project developers. It also obviously signals to the regulators about maybe the need to start to ratchet up as well. Ava, EIB, you're caught in between sort of a dual mandate. You need to develop a lot of this infrastructure, you need to do it responsibly, and you also need to be doing it with the private sector, not in lieu of. So what is your approach, or what do you see as the biggest barriers? And also, I think, what are the approaches that an EIB has taken to address some of these issues pointed out by the private sector?
I think certainly yes, the metrics and the data are issues. Or standardization in the metrics has been a big issue. I mean, if we focus on Europe, data availability is not an excuse, right? Outside of the EU, it might be patchy depending on regions, but I think there are ways of addressing that data gap by using proxies, and we can certainly rely on some of our nature-based organizations of guiding us in terms of the proxies to be used. But I think as a development bank, what we have been doing very much similar to what the IFC or the World Bank has been doing is setting standards to ensure that not only that those infrastructure projects do no significant harm by incorporating a number of requirements or safeguard policies, for lack of a better word. Unfortunately, one of the biggest barriers that we have been seeing is that we get projects at different, especially private sector, at different rates of maturity. And apologies for that. And the issue here is the fact that you might have a project that lands on your desk that has been completely and permitted, the detailed design has been completed, and then you as a development bank come along with your IFC Performance Standard 6, or in the case of the EIB, Standard 3, and have these additional requirements. So then it becomes cosmetic, really. You don't actually fundamentally change the complete design of the project. It has, it has all its concessions, it all has its permits, and so it's very difficult then to engender change in this respect. So one thing that financing institutions like ourselves need to do is to better integrate the biodiversity and ecosystem externalities into our own economic appraisals, understand the trade-offs between the objective of the project and the impacts on biodiversity, and inform our boards so they can make an informed decision. And it could be that the trade-offs are too great that we would say, no, we won't go ahead and finance. And by redirecting that financial flow and by making those very conscious, and they might be very hard decisions, we will have a change in the system, and maybe also a behavioral change.
Great. Well, thanks very much, Eva. And I think you pointed out one of the biggest challenges that many of you deal with, which is just applying the policies and regulations in a said jurisdiction where a project is going to be developed. Is that enough? And I think what you're pointing to, the factor is there is an increasing maybe appreciation that that's a starting point, but you need to pay attention to more issues. And we could talk about many places around the world where we have situations where global investors, at least, are coming in and starting to apply standards which go far beyond what local regulators maybe require. So that's a minimum, but you need to do more. And I think these trade-offs are tricky ones, and certainly data reliant, trying to understand the issues clearly. Eva, you have pointed out that the question is proxies for data and where data can come from, and the important role, I think, of civil society in many instances in starting to generate this type of information. So I don't know, Helena, would you be able to speak to a little bit about the notion of the role or what WWF is doing, and where you see the value of civil society in starting to raise awareness and try to put, I would say, moving it from the Facebook feed in terms of the shock and awe of these are important issues, and then helping actually translate it into a form that can be decision useful at the investment phase. Is that something could respond to?
Yeah, we can. I mean, WGIF does play a lot of a role in this. Like, for example, our engagement in Task Force for Nature-Related Financial Disclosures, for example, it's just one example of a number of initiatives that we're part of that are trying to basically draw attention to these biodiversity risks. And I think some of the role of civil society can be about sort of that interplay between public and private as well, you know, pointing out, you know, where these issues aren't being integrated into regulation, where they can still be material risks for particular financial institutions, but also, you know, that interplay and engagement between the regulatory side and also the private sector side. Just as an example as well, the role of central banks, I think, and financial regulators is increasingly important because they will be able to deal with these types of cross-cutting risks across the economy. And I think, to be honest, the COVID-19 pandemic can be considered as an example of a nature-related financial risk in a way, because it's driven, you know, the rise of pandemics is driven by factors such as nature loss. So I think highlighting this and pointing this out to financial regulators and central banks can also be increasingly important.
Thanks very much, Helena. Now, you've mentioned the TNFD, and a couple others have mentioned it, and there's been some comments that have come up. This is an interesting topic, and there's a lot of debate around it already, even though it's just getting going. And some have told me it's a great idea, but you know, unfortunate we're saying TNFD because everybody draws association with the TCFD, and the situation with nature is different than climate. For those who aren't aware, that the Task Force for Climate-Related Financial Disclosures has been extremely successful in basically making it mainstream practice for the private sector to disclose on climate risks. So in many ways, it's been successful. I think also that there have been many challenges. And probably the biggest challenge, and part of my question here, is to understand climate risk, you can't base it on what happened in the past. Lost histories of what failed in the past, which is normally how the risk management industry operates. You actually need to start looking forward. You have to start doing scenario models of what will happen in a warming world and how will that change or provide different types of risk exposures to our assets or to our loan book or our commercial operations. So I would like to put out to the panel their views. The TCFD, it is not a very detailed framework. It's a set of recommendations, and then the devil's in the detail now of how you apply it. And there's a lot of work going on in the industry now amongst regulators to start to get much more specific on how the financial industry or corporates in general need to start disclosing, to do scenario analysis, to do stress testing. And I guess if we think about the idea of a TNFD, sort of applying this to nature-related risks, I would like to put it out to the panel, and I open up to anyone who would like to speak to it. Do you believe that the industry is ready to start setting such a framework for how you disclose on nature-related risks? Do you believe things like scenario analysis, is the understanding mature enough to actually do it in a way that will provide the information that is required to start influencing decision-making? Can I open up and everyone basically just lift a hand if you'd be willing to speak to that question? Nick, do you want to take that? Oh,
sure, I can start. So firstly, I'd just say from a Macquarie perspective, we certainly support TCFD, and we're certainly very vocal and very focused on climate change risk and embedding that into our risk management framework. And as an example, we on a regular basis assess vulnerabilities to climate change across our businesses and assets, both physical and transition risks, and we run different scenarios under a 1.5 degree warming scenario and a 3 to 4 degree warming scenario. And so I think I feel that, you know, we have a pretty good handle on thinking about what future risks could come from climate impacts, and that has enabled us to very much, make it a central part of our risk assessment in looking at new investment opportunities. I know we've recently declined to invest in a solar project that was located in a zone that we expected to be vulnerable to sea level rise. So, I would contrast that with a question on biodiversity, in that I think it's, for us, still difficult to sort of really formulate what are the risks and how might they manifest in the horizon of an infrastructure investment in the next 10, 20, 30, 50 years. And so I think the industry is increasingly aware of the types or the potential for of biodiversity loss and the risk that might come from it, but it's still it's still much less defined than we would find for climate-related risks. And so that's where I think a task force to standardise the reporting, I think, would be welcomed. And I would also say that from an institutional capital perspective, just the increasing focus on ESG, which is really a great thing. I think that gives fertile ground for the consideration of biodiversity risk, but it's not yet there in the consciousness like climate and risks are, and I think we need to work harder at bringing it to the fore.
Great, thanks very much, Nick. Now, it has been pointed out in the comment box, you do have other groups, for instance, the EU and the EC, is great, is doing a lot of very positive developments, and they have they're reviewing their non-financial reporting directive, and within their more work to be done on sustainable finance and their new action plan. They will be doing more in this space. So one of the questions is, are there processes currently underway to address this data gap? But in general, I don't know if Christian or Nigel or anyone, Eva, would like to speak to this notion of, do we need a task force to try to come up with a set of recommendations on nature disclosures? Nigel? Yeah,
I'll go with it. So, I think it's probably good, and it's worthwhile putting together a task force. I think that thinking should start. I think it needs to happen. I would caution against following too close on the TCFD, purely because, to be honest, I've been through the process of TCFD, and it's quite a complex process. It's very difficult, especially in a financial institution where you're very reliant on data from clients. Maybe if you're in control of your own data, it's very different. But when you're trying to aggregate data from a lot of clients, and obviously when you look at climate change and greenhouse gas data, scope 1, scope 2, that information is largely available. It's also enshrined in legislation. You've got carbon tax. So by all intensive purposes, you're coming off a higher base. If you're coming, when you're looking at biodiversity and you start speaking to clients around this, they're going to be, well, to be honest, we're doing very little, if not, nothing at all. So you're going to be coming off a very low base. And if you, what I'm saying is, if you come too close afterwards, people might just feel that you're trying to take advantage of it. I would totally support the idea, but I think it should be done with, with a small piloted group where you come up, you have an example. This is how it looks. This is what we've done. This is how it could work. And then you almost have a soft launch where, certain organizations start picking it up, rather than the way TCFD's kind of been pushed through the system. But I think it's important, but I would just be, I guess, strategic and tactical in my launch of it.
Okay, thanks very much. And I think actually the powers that be we're listening to you, because actually the state of development of TNFD, it has not been formed yet. It's a preliminary working group to try to scope out whether such a process is merited. So they will be producing essentially the results, which would then lead to a decision, I think, and a lot of it will weigh on data gaps, whether it is possible to generate the data today. Do we have the methodologies, etc., that you can then produce decision useful disclosures? Christian, did you have any comments on that as well?
No, I think these working groups actually push the agenda and make it visible. I think from that point of view, I think it's really a good thing. However, if you allow me, Eric, I would actually like to talk a couple of minutes about the Biodiversity and Ecosystem Service Index that Swiss Re actually developed, because ultimately it's about data, it's about information, and well, we developed actually something that can be used in respect of and can influence decision making of companies.
Please, go ahead, Christian.
Okay, Swiss Re developed this year a so-called Biodiversity and Ecosystem Service Index. So it's a data-driven index. We looked at 10 subcategories of biodiversity, and each subcategory is actually supported by 30 to 70 peer-controlled research papers. So it's enormous data that goes into it. And bottom line, this index is something you can find on our CatNet tool. And it visualizes the world, how the ecosystem, about the state of the ecosystem. For instance, you have an aggregate view, and then you can actually select 10 different subcategories and see what the impact is, for instance, about habitats intactness, water quality, water security, coastal protection, food provisions, and so on. So you have the 10 sub-indices. What is interesting, you see it as a color code. So we developed 7 classes. Red means we have a fragile ecosystem, and green means we have intact ecosystems. And the resolution is 1 by 1 square kilometer. So you actually can zoom in into areas or countries and get an idea about the intactiveness of this ecosystem. Now, obviously, you get some obvious results. For instance, if you look into a desert, it's clear you don't have water quality, water security, and soil fertility, for instance. But if you actually zoom in where you live and you have a red dot, then you know something is not quite where it should be. So from that point of view, it actually gives you this visualization. And again, you can dig into these various subcategories. Now, the users of this tool are governments, for instance. It gives them a view about the biodiversity of their countries, and also then allows them to apply measures to prevent further degradation or actually come up with measures to improve it. For corporate clients, for instance, if you build an industrial site, you can check what is the water security, which then might lead to business interruption issues. But then also you can overlay this information with our NetCat tool. For instance, you can see whether you're in a flood zone or in a wind zone to make decisions about where to build and how sustainable this is. For investors, obviously, it can be used to see, okay, if there are investments in certain areas, is the ecosystem intact there, or might this project then improve or have an impact on the ecosystem? And for insurance, is an additional data set we use in our underwriting. It's actually it's fascinating, it's visual, and it provides some sort of a decision tool that can actually influence investment as well as underwriting decisions.
Thanks very much, Christian. And I think the insurance industry and the reinsurance industry has probably the most expertise in terms of understanding these risks going forward, which of course is very commercially relevant. But as you said, it's very relevant to governments, to city planners, and I guess the question I have, you've mentioned them already. You're providing the data or a lot of the information. Do you find in terms of the government, those who can make use of this data, do they have challenges in terms of the capacity they need to understand and apply it? Like, is it still raises their awareness, but it's not yet decision useful in a policy way? Or is it something that they're quite sophisticated and this essentially feeds into planning processes that they already are fully capacitated to operate?
I guess it depends on country by country. I guess some are very sophisticated, others are there. But I think we take it as an opportunity to actually work together with government entities to educate them and direct them into our research, and then also into the issues we actually see as an insurer or as a big data provider. So from that point of view, I think it's more the partnership to make it happen.
Great. Okay. Thank you very much, Christian. I'd like to turn to Eva. Eva, you mentioned, I think, one of the very important roles of the big development banks, which is not only mobilizing investment, sharing risks, but also is in standard setting. And your role in establishing safeguards that you apply with your commercial clients, but also that the others in the financial industry pick up, is really key, particularly in emerging markets in developing countries. Could you speak a little bit to where you believe the safeguards maybe could be extended over time to help address some of these nature-related concerns? I mean, the basics are already there, and I would say are being applied from the most material obvious risks. But as we know, and as we're discussing, a lot of these risks, the materiality and other aspects become more challenging to understand. What role do you see in EIB in driving the safeguard agenda? How much do you think that can address some of these issues?
Oops, sorry. I was on. I do think it's important. I mean, most of us development banks or public sector banks finance a number of projects. And it is very important that we push the boundaries, but we also have to understand that there is also work that needs to be done in terms of capacity, having the right experts on the ground, training those experts, having the consultants to support our commercial clients and promoters alike in implementing those standards. One thing that we have found is, I mean, there has been a big move towards the harmonization of the standards amongst the multilateral development banks. So we have very similar requirements. But we are not very good also at reporting on the impacts. And I think we were discussing reporting on our biodiversity impacts, also on the negative impacts of biodiversity on the projects that we finance. Once we have also integrated our safeguard policies. Actually, we don't actually know how well we are doing in terms of the outcomes of having mainstreamed or integrated those safeguard policies. One thing that we think will certainly help, especially in better regulated environments, are the do no significant harm criteria under the EU taxonomy. And this will provide also for a level playing field. It's a standardized requirement, and it will be for every infrastructure project or economic sector that will have to apply those criteria for their individual projects. And I think that will help certainly align, let's say, the requirements that we have or that any other multilateral development bank has. And these requirements have been integrated in the do no significant harm criteria. If you look at it closely, there are even references to the safeguard policies of the multilateral development banks. And I think then you end up having, I think it was Nigel who mentioned the level playing field and also a standardization across sectors of the requirements that need to be implemented. But nevertheless, we can't remain static. We need to continue. We need to see how pragmatic our policies are. Are they implementable? They may look very good on paper, but on the ground, very difficult to implement because of differences in capacity, but also because they're not sometimes realistic. And sometimes, you know, we develop these policies in our ivory towers without thinking of what the reality is on the ground.
Great, thanks very much, Eva. And I want to challenge you on that in 1 second. I'm going to come to Helena to talk about the TNFD in a moment. But Eva, just before we go on the issue you're talking about, because I'd like to get to the topic of one of the problems when we're trying to see leadership in a new sector, like on these issues, is the leaders will basically sometimes point out, what about the laggards? What stops them? You know, if I don't do a deal, somebody else might pick it up. And so the question I have from an EIB perspective, you know, you have strong safeguard policies, as you say, they need to be updated over time. What do you deal if you have a corporate client, you're looking to finance a specific project activity? Does your safeguard apply only to that project? Let's say it's a client he's going to do something really green and really great, but it just so happens elsewhere they're actually financing a lot of unsustainable palm oil. How does your safeguards apply holistically to your corporate clients versus very focused on the specific transaction that you're looking to finance?
So it will depend on the type of financing we're providing. So if it's a corporate finance loan, then we look at the whole corporate itself. I mean, traditionally, as of today, this is going to change because with our new climate bank roadmap, which includes environmental sustainability, we will have all our operations need to be Paris aligned. And Paris alignment is not only about climate, it's about resilience and environmental sustainability. Because if you don't have the environmental sustainability, and if you do not include, for example, biodiversity risks in your climate risk analysis, you are completely undervaluing or underestimating the climate risk. So when we talk about Paris alignment, we will be looking at, so we would be financing, I can give you an example. We had a European utility that generally generates most of its electricity and power through coal, but they were they came to the EIB to finance a wind farm. In this case, we needed to make sure, okay, that the wind farm has all the, has met all the requirements, has all the safeguards in place. But we looked at the utility and said, can we finance that utility? Because actually it has in its portfolio a lot of unsustainable activities. So as of today, the Climate Bank roadmap will be approved at our next board meeting, which is in a couple of weeks' time. The position that we used to have, meaning we just finance the project and we ring-fence our financing to the project, unless it's general corporate finance. This will change going forward. And this is going to be a big shift for our bankers and loan officers. And there was initial pushback because we still are built on an incentive. Our incentives are skewed. It's volume driven, right? And so here we're going to see a complete shift in the type of financing we do and the financial flows. And that's going to be let's say, quite a bit of adaptation on the side of our loan officers and bankers that will need to take place.
Great. Well, thank you very much, Eva. This is an extremely important development. And I do hope other development banks will follow your lead on this, because this will have a huge impact, I think, on motivating ambition change. It's not about doing a couple of green transactions. It's about the alignment of the entire portfolio, entire business plan, business strategy. I believe, Nick, I think you need to jump off to go to another commitment.
Nigel, I think.
Excuse me, Nigel. Excuse me, Nick. Nigel, I believe you need to jump off. I don't know if you have a last word you'd like to say.
I guess, you know, to just maybe touch quickly on the business side of biodiversity, and you know, I think you know, there's a lot of opportunity in this space as well with regards to, you know, certain performance-linked loans. So, you know, you will have seen these sustainability-linked loans. I don't see why in the future we couldn't be structuring certain infrastructure projects to have these performance-linked loans. The real issue around the biodiversity is then going to circle back to what we've spoken about, and that's very much to do the measurement and the metrics. If you can get the right measurement, we can get the right metrics, we can set the right targets, and I can structure a loan like that. At the moment, without those, it becomes slightly difficult. But you know, as I said, there is a lot of innovation in this space. There's a lot of work we are doing. There's some work that we are doing at the moment with regards to wildlife conservation bonds. That we were hoping to, you know, get out, you know, in the next couple of months. And I think if we can have success with that, then I think we should catalyze a large portion of kind of the sustainable finance industries to start looking towards kind of biodiversity outcomes as well. But yeah, thanks very much for having me on the panel. It's been very useful.
Wonderful. Thank you very much, Nigel. And I think you have pointed out a very new, important financial product. If we think of green bonds and all the success they've had, sustainability-linked loans is the next big thing. And I think we see a lot of potential. There is a lot of uptake. It's still early, but it's a whole notion of obviously tying a loan, traditional loan, to specific greening or sustainability-oriented outcomes. And I think, as you said, particularly in the private finance market, there's a lot of potential, I think, to actually make a lot of progress there. If we can get the data, the measurements right, if these can be credible. And I think that puts a lot of requirements on financiers, but on developers and obviously on others in the community to come up with systems that are credible. So with that, thank you very much, Nigel. Appreciate you taking your time, I think, extending into your next meeting. And you have to jump off. I would like to come now to Helena. Helena, you wanted to talk a little bit around the TNFD.
Yeah, I just wanted to briefly say something actually more about the opportunities and benefits side, just touching on the points just made by Nigel actually. So I really think that there's also a lot of benefits and opportunities rather than just, you know, talking about the risk, which is obviously important. I think like for the climate side, we also need to consider what actually the opportunities of restoring nature are, particularly for infrastructure. And just a couple of examples to raise here, for example, you know, nature-based solutions can actually increase the resilience of infrastructure. And there's already a lot of examples and reports about how that can be integrated, but also in the water sector, which I think obviously the water sector is already integrated a lot, and it's almost more mainstream actually in terms of the benefits of trees and forests for water management. But in other sectors as well, like transport, I mean, intact forests can actually make a road or rail infrastructure more resilient, preventing landslides and erosion. And we've actually done a report on that topic in Myanmar as well. So I think there is various examples that perhaps we need to kind of look at as well and highlight that these can be more mainstream and also, as Nigel mentioned, probably turn into financial products in future, which is one area where the development banks as well could probably play a kind of catalyzing role and help lead the way in various ways.
Well, thanks very much, Helena. And I would like to shift the conversation a little bit in this direction. Christian, you had mentioned earlier that Swiss Re is part of this group, this Net Zero Asset Owner Alliance, which we and WWF are very privileged to be supporting. This alliance, they've committed to 2050 net zero. There are a lot of commitments to that, including, as I mentioned, from government like Korea and Japan and China. However, 2 weeks ago, this group, you issued for consultation your target setting protocol, which basically says how you're going to deliver. And the most impressive part of that is you've put out a 2025 commitment, which will be a range between 16 and 29% reductions across the portfolio, CO2 reductions. Now this becomes a near-term business target, and that's when things really start to happen within organizations. And I want to shift because we're seeing so much momentum around not only disclosing on climate risks, but also starting to align portfolios with this net zero, this 1.5 degree transition pathway across all industries. So we're seeing progress there. What can we learn from that? And you know, can we start to think about similar type of alignment approaches related to nature? You know, could we start to think at the portfolio level of no net impact on biodiversity? What does this mean? Because I think part of the view is as we grow from getting and doing individual transactions in the best way possible, in terms of what Helena is referring to take account of the opportunities, you really need to start setting business targets. And those targets starts from, you know, no net harm, do no harm, but it's basically say, hey, we can make business out of this. We see a lot of need in society to be addressing these issues. So let's set portfolio targets. Can we do this for nature and biodiversity? And I throw that out to the panel. Anybody like to take that?
Yeah, just
Helena?
one interesting point to jump in. Probably, I guess we haven't yet had or seen what that biodiversity target is going to be like at the global level. I think when the global goals are set, it would be really interesting for the financial institutions to actually align themselves with global goals that are set under the biodiversity framework.
Any other comments on that?
Yeah, I actually would like to comment on that. I hope we can do it, because ultimately Swiss Re made a promise that on the asset side, we are going to be net zero by 2050, and also on the underwriting side. So if we live up to that promise, we actually have to make it happen. So from that point of view, it has to be on a portfolio basis, because you can't do it on a deal by deal basis. But I think these promises, I think they are underpinned by tangible action items to get there. Otherwise, we wouldn't have done it.
So I think, and huge respect to Swiss Re, and you're very involved. And as you say, it's not only the target, it's actually how do you do it. And it's not only the data, which is a challenge, but it's also how do you apply the data in ways where you can start to engage with the companies, your clients, on essentially helping them transition. Do you believe that these approaches are relevant for these nature biodiversity challenges we're also looking at?
I think they are, yeah. I think it's not just the decisions you actually make, but also the decisions or the industry you actually step away from. Because sometimes you actually have to let go of business that looks profitable from an underwriting point of view, from an IRR point of view, but you don't do the right thing. You look at coal, for instance. I mean, this was a decision we made, that we actually have to step out of this industry and start supporting them with, or stop insuring them, and basically force changes into the world. I think with biodiversity, it's a little bit less tangible at the moment, but we are definitely getting there. And what I definitely like, I mean, we see pockets of developments. For instance, I was speaking earlier about nature-based solutions. For instance, we supported a project in the Netherlands. It's in the press everywhere, the Prince Hendrik Dike, where we had actually a chance between a grey infrastructure dam project or a nature-based project. And we were the lead insurer there to make it happen. So basically it was a 3-kilometer stretch. We had to move 5 million cubic meter of sand. We had to replant it. But now this project actually creates a new habitat for species, but it's also very attractive to the public. So each year there are 1 million visitors going there, enjoying nature, and basically have quality of life. And I think we could have said, no, it's too new, it's unproven, but we actually stepped up, insured it, make it happen, and therefore we could develop or contribute to something that really has a positive impact.
Christian, is Swiss Re, are you not the first to insure coral reefs?
Well, we were the first one. You actually referring to the Quintana Roo transaction we did for Mexico. That was interesting because studies showed that if a hurricane level 4 goes through this area, about 60% of the corals and a lot of, obviously, the infrastructure there will be destroyed. So what we did was we issued a cat bond that provides very quick financial relief, and this financial relief can then used literally immediately to start to restore these corals and this infrastructure. Basically, half of the funds go to the coral restoration, and half of the funds will be used for the beach restoration. But that was actually a solution where it's not a prevention, but it basically gives financial relief after an event to rebuild.
Great. Okay. Thank you very much, Christian. Okay. So we only have a few minutes left. I would like to circle back in coming back to each of the speakers, probably to ask you to address the most fundamental question. This has come up in the chat box. Some of you made reference to this, but maybe if I could read it, it's basically, what's the evidence for biodiversity risk as a financial risk? And, you know, some views, I think, justified to some extent, are that you know, many market incentives make it profitable for companies to exploit resources and essentially to pollute, as has been raised. Pollution is not always priced in. So what from a commercial perspective, what motivation do you have and commercial rationale to actually be moving forward in some of the ways you're describing? How do we ensure that biodiversity risk is a financial risk? Do you want to take that first, Christian?
Yeah, sure. I mean, first of all, I would say loss of biodiversity and climate change, it's real. It's not fake news. And actually, we have to act now. For instance, studies showed that by 2050, one expects that 30 to 50% of all species might be lost if you don't take action. So from that point of view, it has an impact. We see a number of studies. For instance, the Dutch National Bank said that 510 million euro, or 36% of investments of all Dutch institutions, are actually vulnerable to economic services. So if we don't take action, then this has really material impact on the ecosystem, but then also financial impact. So from that point of view, I think it's real. And we have an opportunity to first have support projects to have a positive impact, but then also as an insurer to help them to de-risk those projects, to bring them off the ground.
Okay, thank you, Christian. I think, Nick, if I could come to you. Now, I realize, I believe you're on the investment banking side of Standard Bank, so you're seeing various dimensions around how transactions are put together. Do you see a culture challenge within a big banking institution to the notion of nature risk is a financial risk? Is that a hard message to discuss? You get some pushback?
And it just from with Macquarie on the investing side. So
I'm sorry, Nick.
That's okay. No problem.
From a Macquarie perspective.
But the question's still a good one. Look, I don't think, is it a hard sell? I don't think we're at the level yet that it's sufficiently front of mind and sufficiently considered in the financial investment decision. I think for biodiversity to be truly considered as part of that, we need to actually we need to consider its value, and we need to be able to value biodiversity in some way. Right now, I don't think there is a sufficient recognition of its essence to human health and human well-being. If a good or a service is worth something to you, then you'll be inclined to pay for it and to recognize it. And so I think that there is still some way to go to elevate biodiversity and the value of biodiversity and the risk of loss of biodiversity to a level that is going to be a serious consideration in investment decisions. I think we've spent decades at climate change, and now I think it's pervasive. There's broad consciousness, there's a broad recognition that this is real, it's happening. We have to address it. It's a fundamental risk to the economy and to society. And that's led to, I think, unprecedented and coordinated action around the world. And you mentioned governments committing to net zero, and we need to advance that same discussion on biodiversity to a similar level. And I think that at that point, it really the value of biodiversity is recognised. That drives politicians and businesses, their move to act, to put it and to that I think then leads to government support and policies, market mechanisms that are developing, that developed effectively to recognise and value that biodiversity. And so if I was to sort of say what is a real objective in terms of biodiversity and how we can sort of tackle the devastating loss of it, I think it is advancing that public and civil society recognition broadly and globally that this is a fundamental risk that we need to address. And I just don't think we're there yet.
Great. Okay. Well, thank you very much, Nick. I think you have summarized very well I think the perspective from, I would say, the more progressive are those who are leaning in from the commercial financial sector into these issues. There's a lot of work to be done, but a high level of awareness and engagement to take us there. I have to apologize to Helena and Eva. Unfortunately, I think I've mismanaged the time a little bit, and I realize I need to pass it back to Christina and Ryan, who are going to give some final words. With that, I would really like to give a big thank you to this expert panel, a fascinating discussion. And Christina, if I can hand it over to you.
Thank you very much, Eric, and it has been really a fascinating discussion. Thank you very much. It's very difficult to summarize everything in 2 minutes, but let me try very briefly before we close this. So indeed, we all understand the urgency. Biodiversity is rising on the global agenda, particularly in the context of COVID. We have twin crisis, or even triple crisis, shall I say. And 2021 is a big year for mainstreaming and integration of biodiversity risks in investments. And we'd better start now. We have just one decade, critical decade ahead. We have looked into the issue from two sides, the risks perspective, as well as the benefits and the opportunities for restoring nature, particularly for investing in nature, particularly in infrastructure. And how can we speed up investment in infrastructure that has a positive impact on biodiversity? That's the key question. So fantastic group of speakers, very broad expertise. I could feel the passion both about finance and biodiversity. We understood biodiversity is a financial risk, but yet we are at early stage of integrating risks related to nature and biodiversity in the investment. Some of the key barriers that we've identified, the complexity, the gaps in metrics, disclosure. And I've seen a very long contribution now on disclosure from one of our participants. So thank you very much for that, for participating actively in the debate. We discussed the need to price in biodiversity risks accordingly, to value biodiversity in an appropriate way. We also discussed the role of the various players, including public development banks and their environmental and social safeguards, central banks and financial regulators, but also the role of civil society. And I'm very grateful to have WWF with us and many others in the audience contributing. There's a number of initiatives that were discussed at greater length, such as the TNFD, that are here to help address some of these challenges. Obviously, we are not yet there. The EU taxonomy and in particular the do no significant harm criteria come very helpful and very timely. There are many tools that our panelists shared and described in some details, and some of our attendees also added on the debate. So thank you again for that. And we also discussed the different business opportunities, biodiversity loans, maybe even wildlife conservation bonds, modeled around the success of the green bonds. We discussed the different opportunities around nature-based solutions, which is a topic very close to my heart in particular, and very close to EIB. We have developed special products that indeed look into that link between nature and good business. And yeah, very, very interesting to hear about the different views on alignment approaches with regards to nature on portfolio level. How do we set targets on a portfolio level to ensure no net impact or even positive impact on nature? So with that, let me thank very much with a virtual applause to all the panelists, to our great moderator, to all the attendees. And to close this webinar, the floor goes to Ryan Bartlett from WWF, who will tell you more about what else we have in the pipeline. So thank you very much.
Thanks so much, Christina, and thank you to those of you that are still on, and the more than 200 of you that joined us for the full 90 minutes this morning. This is just to remind you that this is part of a series of webinars that we have been organizing since early October that will go through December. Our next event is next Thursday, same time, although the time will shift as we fall back here an hour in the United States. We'll be back at 2 p.m. CET on Engineering with Nature, moderated by Lynn Scarlett, the Nature Conservancy, with some great additional contributions from Harvard, the Army Corps of Engineers, AECOM, the Los Angeles Transportation Authority, and others. If you want to find out more about this series in general, you can go to iene.info, where you'll find the webinar information at the top there, including recorded videos of each of the first sessions and as well as this one, which will be uploaded. And you'll see a link from us in a few days. So thank you so much for joining us. It was a really fantastic discussion, and we look forward to seeing you next Thursday. Have a great day, everyone.
Thank you. Thanks, everyone.
Thank you.